Stable dividends, despite the uptick in inflation and interest rates, is still priority for many investors. So how can you navigate the choppy waters without disrupting your dividend investing strategy? Stick around for the answer. Lance McGray, head of ETFs at Advisors Asset Management, joins us right after this. Hello, I'm Stephanie Stanton with ETF Guide. Thank you so much for joining us. If it is your first time watching, hit the subscribe button and post your comments below. All right, we've got a lot of ground to cover on today's show. Is stable dividend income with stubbornly high inflation still possible? What's behind the upswing in value stocks, and will it last? Well, joining us to talk about all of this and more is Lance McGray, head of ETFs at Advisors Asset Management. Hi, Lance. It's great to have you with us.
Hi, Stephanie. As always, it's great to be with you.
Okay, so we've seen a massive leadership change in the stock market this year. Value stocks now outperforming growth stocks. This trend has favored funds like the AAM S&P 500 High Dividend Value ETF, and that ticker is SPDV. Do you think the trend of value over growth has legs?
We do. We continue to think that we are just in the beginning phases of a secular regime change, right? And history has shown us that higher rates and inflation generally causes, a repricing not only in the equity world, but also in fixed income assets as well. And this is exactly what we've seen over the past 1 to 2 years as value-oriented equities have drastically outperformed the growth-oriented peers quite substantially as well. So yes, we do believe there is a leadership here. I've been mentioning it for a few months now. And as inflation lingers, right, obviously much longer than most thought, and interest rates continue to rise, we feel this trend does have legs. And from that perspective, we feel that SPDV, as you mentioned, the AAM S&P 500 High Dividend Value product, is positioned really, really well to capitalize on this type of environment. Not only is SPDV a value-oriented ETF, right, so it offers attractive valuations, but the real differentiator here is it's a value product that really also focuses on dividend income as well. And this is a really important component because as we expect here at AAM, that growth is going to be muted going forward, and a large component of capital appreciation going forward is going to be really driven by income, right? And so if you can get an SEC yield of around 4% out of this product with attractive valuations, it is really a really timely solution to capitalize on that rotation to value, but also mitigate any potential losses with a 4% dividend yield that can actually act as a cushion going forward.
You mentioned that dreaded I word, talking about inflation. Obviously, the Fed has been hiking interest rates to fight inflation. Despite the uptick in interest rates, the AAM Low Duration Preferred and Income Securities ETF, and that ticker is PFLD, has held up much better compared to peer ETFs tracking preferred securities. What do investors need to know about PFLD?
Yeah, so PFLD is a rather unique solution, right? In fact, PFLD is the only low-duration preferred ETF out there currently in the market that focuses on $25 exchange-listed preferreds. And this differentiator is actually one of the reasons why it was the top-performing preferred ETF in the first half of 2022. And we think this is going to stick as interest rates potentially rise higher. PFLD, just like SPDV on the equity side, PFLD is really positioned well to minimize the impact of rising interest rates. Its current SEC yield is over 6.10, and it has an effective duration of about 2.5 years. So if you think about those two in relationship to each other, it's a very, very unique solution for income-seeking investors who are worried about the impact of rising rates. And we're seeing a lot of investors. In fact, it's one of the very few preferred ETFs that have inflows in 2022, because what we're seeing is a lot of investors who are really utilizing the preferred space but have capital losses on the book. And they're migrating out of those losses, realizing those losses, and getting into a solution like PFLD where you can actually, potentially increase your yield decrease your duration risk, while also realizing losses along the way. So really interesting solution here. Again, it's the first and only low duration preferred ETF in the market right now, and it's a really attractive solution for those income-seeking investors that are worried about the impact of rising rates going forward.
Yeah, I mean, you mentioned 6%. I mean, heck, with everything, in the red these days, 6% is looking pretty good. So, all right, let's shift gears a little bit. Talk about the AAM Transformers ETF. That ticker is TRFM. It was recently added to your roster. The fund targets companies that are proven innovators. Tell us a little bit more about TRFM's investment strategy and some of its holdings.
So Transformers is the newest addition to the AAM ETF lineup here. In fact, it is our first non-income focused ETF that we have. And we're really excited about this solution. It helps diversify our product lineup. And really, we're excited about the partnership with the team at Pence Capital Management to bring this product to market. So Transformers is a rules-based ETF, which tracks the Pence Transformers Index. And as you would expect from the name, it targets companies that whose products and services show compelling potential to transform consumer behavior, technological innovation, and really transform the global economy. So it's really an interesting solution that are for those investors that are focused on growth-oriented, niche-y type products. But really where Transformers separates itself from the pack in terms of other thematic growth strategies is that not only like those solutions does it look at traditional metrics like R&D spending and sales and growth, but it also incorporates analyst ratings. And that's really important because we try to not only try to find companies that are growing, right, quickly and substantially, but we're trying to minimize our exposure to those bad apples, if you will. And that's really a differentiator for Transformers. Again, it's only a few weeks old. It was launched a few weeks ago and it has an expense ratio of 49 basis points.
And then over the past year, we want to talk about the AAM Bahl and Gaynor Small Mid-Cap Income Growth ETF. And this ticker is SMIG, S-M-I-G. It has delivered better results compared to both the S&P Mid-Cap 400 Index and the Russell 2000 Small Index. So hats off to you there. That is a pretty impressive feat given the challenging environment that we're seeing right now with the stock market. What is behind SMIG's success?
So first off, this is an actively managed ETF. This is a 100% transparent active ETF, which is sub-advised by Bahl and Gaynor. And really, that's the secret sauce, if you will, right? We've just surpassed our 1-year anniversary, and the momentum is building, and it continuously builds as we've quickly surpassed $100 million in assets. And for those of you who aren't familiar with Bahl and Gaynor, they're a multi-billion-dollar asset manager based out of Ohio, and they really focus on one thing, and that's income growth. And what this solution is essentially the small and mid-cap version of their very well-known larger, or if you will, larger brother income growth solution. So really, what we're trying to do here is we're focusing on generating high level of current and growing income with holding high quality dividend paying small and medium sized companies. So really interesting solution here for those that are sort of looking to navigate the small and mid cap space and maybe don't want to do it through a traditional beta solution or a market cap weighted solution. This is a great way to sort of blend the benefits of an ETF, tax efficient, low cost ETF, with really a proven asset manager on the active management side. So we're really optimistic about this solution. It's been out there for about a year now. We're over $100 million, and quite simply put, this solution really looks to deliver on 3 key objectives, and that's number 1, generate high current income and growing income. Number 2, provide downside protection. And number 3, provide price appreciation potential. So far, the product has done exactly what it's supposed to do, and we are really optimistic about the partnership with Bahl and Gaynor and the prospects for SMIG going forward.
Thank you so much, Lance McGray, for dropping by, sharing your insights.
Thanks a lot, Stephanie.
And be sure to visit aamlive.com to learn more about the ETF lineup at Advisors Asset Management. The link is also posted in the description section below. And don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs, just like this one, along with ETF battles and the many others that you can also find. You can check us out on Twitter at ETF Guide. I'm Stephanie Stanton. Thank you so much for watching. We'll see you next time.